Hello everyone, my name is Kamal Manocha. After the grand success of our Crystal Gazing 5.0 over last weekend, we are back with the rhythm of our weekly webinars. And today we have Mr. Chokalingam from ICICI AMC. He's the fund manager at the alternatives division of ICICI AMC. And all of us know ICICI AMC has been doing very good work in terms of performance. So, it will be our pleasure to hear Chokalingam talk about ICICI's house view, for the next financial year. We are going to end this financial year on a very good note, but everybody is worried, what looks ahead. And that is why we have kept the topic of this webinar as stay the course. So what does, this topic convey is the overall context of this webinar. We will hear it from Chokalingam. Welcome Chokalingam to this webinar. We have been doing My pleasure. We have been doing these webinars every week on Friday to keep our clients, our audience well informed of, what smart investors are thinking, what's going ahead. Maybe you can start with your observation of what happened in markets today, and then we can move ahead with your presentation.
No, sure. So thanks a lot, Kamal, for having me, and good evening, viewers. Very warm welcome. Today I don't know whether what's the specific news. The only thing that we could think of in terms of what's taken the markets probably up is the GDP data, which kind of came last evening. That was quite buoyant. That was ahead of most expectations, and particularly like what we've been kind of seeing in the markets, where we've kind of seen the earnings buoyancy kind of come in from the manufacturing sector. We've seen in the GDP data also the GFCF data being particularly strong. So I think that's one particular element which has kind of driven the markets. Outside of that, there's also been expectations with regards to possibly some sort of stimulus which is possible, which could come through in China, which has been kind of subdued for a very long time. So possibly that's kind of fueled the rally in the metal space as well. So I would say it's slightly more reading into the data and in anticipation of some of the developments globally is what the kind of move today is. We typically don't focus too much on some of these daily moves. Whenever we typically take a call, because equity is a very slightly more longer term asset class, right? It's a higher risk asset class. We tend to take a more longer term view. The longer the horizon that one gives for an asset class like equity, I think greater are the chances for doing well in the markets. So which is why improving the time horizon for equities is actually very critical. So that's something that we've kind of looked at as far as when we look at equity markets. So if you actually look at the slides also, the year gone by, when you kind of look at it, last year we had a fairly subdued start to the year. Cautious start to the year, but then subsequently we had two drawdowns, but then subsequently the markets did pretty well. So if you look at slide 4, you'll kind of see that particular aspect being quite visible, and the rally was actually driven a lot more by the mid and small caps. And one of the reasons why that's kind of also happened is if you kind of look at the composition of where the manufacturing and manufacturing allied businesses have been historically a lot more better represented, is actually more in the mid and small caps. If you actually look at the top 100 companies, you would see that representation of it's a lot more represented by the services businesses, which is where we've not seen as much earnings growth as what we've seen in the
if I may please interrupt you. So the presentation is live. You can maybe if you can navigate the same and maybe take slide by slide.
Yeah, so slide 4 is what I've initially year gone by I kind of covered. Slide 5 is the aspect on the mid caps and small caps kind of coming through, which is the part that we're kind of now talking about, that the representation of the manufacturing and manufacturing allied businesses is slightly more in the mid and small cap. In fact, in the top 100, the representation of manufacturing and manufacturing allied businesses is less than 1/3. Whereas when you move to 101 to 250, which is the mid cap space, that number increases for manufacturing and manufacturing allied businesses to almost about 44-45%. And as you move down to the small caps, this number actually inches up closer to 50%, and below 500, it actually is well ahead of 50%, which is why you've kind of seen the some amount of this rally being justified by the earnings-driven moves in these particular segments. Not saying that every move has been justified. There are some pockets of you could say excesses which from time to time gets cleared. So that's not too much of a issue. I think what one needs to kind of look at is slightly more longer term orientation and follow earnings, follow ROE improvement, and look at what's the risk reward. That's what we typically do. So if you kind of look at the reason, if you when you look at the next slide, this is the aspect that I was actually talking about between the one more following.
You can maneuver these slides, right?
1 second. Oh yeah, okay. So this is where we were talking about this particular aspect with regards to where the earnings have come in and where the markets have done well. That's largely because when you look at sectors which have done well, they are particularly sectors where the earnings growth has been actually quite punchy. So within that also, when you look at it, it's B2C and B2B. The B2C side also, while the profits have been good, it's been a lot lesser compared to the B2B companies, and which is where you've seen a lot more pronounced movement as far as the B2B companies are concerned. What's leading the market counter-cyclical with regards to the capex that they've kind of undertaken, which is particularly during the infrastructure spend, and that's really driven the pickup. Added to that, we've seen a pickup in real estate, which is more individual related capex. And now finally the private sector is also joining the bandwagon as far as capex is concerned. So which is where you're kind of seeing a pickup in private sector capex also, which pre-COVID was hovering around the 550,000 crores, is now moved to about 8.5 lakh crores sort of a capex. So this is again something very, very important fundamentally happening with regards to the markets, or rather the economy. And this is the aspect yesterday's GDP data also. If you kind of look at the previous quarter's numbers, you've seen a more pronounced improvement in GFCF, which is gross fixed capital formation, which is represented on the left axis. There you can see that it's now inching closer to about 34-35%, which is probably after a very long time we're seeing these kind of numbers. We saw this last around the 2010, 11, 12 time frame. As far as private consumption expenditure is concerned, while that's also been improving, the magnitude of improvement that's on the right scale, you'll see that the improvement is barely about from 55-56% to 58-59%. So to that extent, it's not as pronounced as what we've seen. The magnitude of improvement has actually been a lot more pronounced in the capex side. Added to this, what's also happened is all this is happening at a time when the corporate balance sheets have actually improved quite a bit. So if you look at the last decade levels, we are probably at one of the best levels as far as leverage levels in the corporate sector is concerned. One of the key reasons for structural reforms that have been carried over one way for the next decade. So that's something very important. This happened, on the fiscal side in terms of GST or direct benefit schemes or divestment programs and management of PSUs or rationalization of fuel subsidies. So we've had a plethora of fiscal initiatives taken. Added to that, the counter-cyclical improvement as far as in terms of investment is concerned, that's kind of increased. We've also had a host of governance related reforms and changes that have kind of come in. And finally, on the banking side, we probably today are sitting with one of the best digital backbones globally as far as any particular country is concerned. I think we are at one of the best setups as far as financial structure and market is concerned. So policy continuity comfort has particularly improved following the state elections. Now we'll need to see whether this kind of gets translated into the general elections as well. But at least from what the markets seem to be reading, they seem to be deriving comfort that policy continuity could very well be there. So at our end, what all this basically boils down to is we need to look at what does it mean for earnings and how should one look at it. Because at the end of the day, earnings are the biggest engine for driving the markets. PEs is more driven by sentiments and also the improvement or deterioration in ROE. So to that extent, it's very, very important how the earnings are being driven and what sort of capital intensity is being used up to drive those earnings. So and when you look at that, what you're clearly starting to see is the fact that after a prolonged period of subdued earnings growth, we are actually seeing a marked improvement over the last 3 to 4 years. This has come on the back of two things. One, because inflation has kind of come back, interest rates are kind of settling at a higher level, because of which there's no more free money in the world. For the greater part of last decade, particularly in the developed world, you had access to pretty much capital at 0.5%, 1% sort of levels, which basically meant a lot of disrupting companies kind of got funded, and they came and disrupted the profit pool of established companies, and particularly the capital intensive ones got impacted the most, because they had a decent management who could execute. If capital was available cheap, businesses got disrupted quite a bit. Roll forward to today, I think we are having because the interest rates have set to supply chains. We have seen earlier in the last decade, for a greater part, we were also used to relying primarily on one large global supply chain. I think today it's a combination of local supply chain, friendly supply chain, and global supply chain. So these three facets, effectively have meant that capital-intensive businesses and manufacturing ecosystems are starting to come back into a lot more economies more locally, which effectively is opening up bigger opportunities for capital-intensive businesses, which are traditionally more in the manufacturing and manufacturing allied segments, which is where we are seeing better pricing power now starting to come through. As a combination of these two factors, one, higher interest rates, and second, lack of competition as a result of that, and movement of supply chains. So as a result, you're seeing better pricing power for some of these businesses, and hence improvement in profitability. So that's again something that's starting to come through. This is where I was kind of talking about while the markets have had a great run, the healthy part of that is there has been also decent earnings growth. It's not been all P improvement or price to book improvement. When you kind of look at that at various indices levels, you will kind of see that it's not all multiple re-rating. It's been earnings growth as well. And when you kind of compare where these numbers are today versus long-term averages, you can clearly see that the large cap index is probably about 10-12% premium, whether you look at price to book or price to earnings is concerned. But mid caps are probably about 15 to 20% more expensive versus average, and small caps are possibly about between 25 to 30% more expensive as far as price to earnings and price to book multiples are concerned. So which is where we are kind of so at an index level there is some amount of expensiveness that one could see as far as mid cap and small cap is concerned, but large cap is still reasonably okay. But bottom up, if you were to kind of still build a portfolio today, you're still okay to look at you're able to build a decent portfolio with good risk reward. We'll come to that aspect slightly later. This is the aspect that I was actually talking about, manufacturing and manufacturing allied. So when you kind of here look at the top 100 companies, you will see that manufacturing and manufacturing allied businesses make up only for about 31% of that particular index in terms of weights. 68-69% of that is predominantly driven by services businesses. Whereas when you move down the market cap curve, the representation of manufacturing and manufacturing allied businesses has started increasing, or rather is higher. Not started increasing, is higher. So key themes as we look into this year, first is we believe literally every technology change that is kind of happening, you're seeing pretty high energy intensity, whether it's green energy, whether it is electric mobility, whether it is pretty much everything that you're kind of talking about today, you are seeing higher energy intensity going up in the world. Added to that, unlike the past, say last decade, when a lot more of the population was used to power cuts, this time around in the country, the current generation is a lot more hooked on to mobiles and a lot more aware, a lot more and these have become very, very important. Security and energy stability is something which is at the core, and the intensity of this needs is only gone up quite substantially, which is where I think that's the first theme that we kind of see, that we are likely to see higher energy requirements across the entire value chain. We see a lot of businesses, whether they are solution suppliers, whether they are financiers, whether they are developers. So be it in the generation, transmission, distribution, be it any of these sectors, you're looking at this. This is something that's this is a multi-year theme, not particularly valid only for this year. It could be a more 3, 4, 5-year phenomenon, which is something that we are looking at. The second thing that we are kind of looking at is the fact that the real estate cycle has kind of come back after a very, very long time. We are possibly into the year 2 or year 3, depending on which micro market one is looking at as far as the real estate cycle is concerned. And when you look at the top 7 cities, for example, is concerned, the housing inventories are possibly at one of the bottom levels. So effectively, it's only as much as the end user demand, and typically it takes about 1.5 to 2 years to build a house a year, across most of the large cities. And to that extent, it seems like the real estate cycle could have legs, and that's something that we're seeing on ground as well. And that particularly has impact across the because real estate kind of cuts across multiple industries. The entire real estate value chain is kind of quite long. Whether it's building products, whether it's construction materials, whether it is developers, whether it is electrical goods, whether it is construction workers, whether it is housing financiers. So there are a whole host of companies which kind of benefit out of a real estate cycle. And on top of it, you also have a bit of wealth effect, kicking in whenever the real estate cycle kind of is in favor. you do see wealth effect coming into play as well. Third is government capex on strategic sectors. I think government has been very, very counter-cyclical, and which is where even though we had during the COVID phase a bump up in fiscal deficit, I think that bump up in fiscal deficit was of very high quality. What do we mean by really high quality? It went into sectors where there was higher multiplier impact. So whether you looked at railways, whether you looked at roads, whether you looked at defense, so these are areas where typically you saw big pickup in government capex, and that kind of is continuing. So here again, when you kind of look at it, a whole host of players kind of benefit, whether it is EPC players, whether it is mobility equipment makers, which is basically truck manufacturers, or defense equipment makers, defense solution providers, a whole host of companies which participate, in this aspect. Theme 4 is largely financialization on a sturdy digital backbone. I think today India possibly has one of the best digital backbones in the country, whether it is the Aadhaar UID or UPI or the GSTN network or the direct benefit transfers. When you kind of look at the entire ecosystem, I think it's unparalleled today across the world. And the quantum of transactions and value of transactions have been quite high. So this is this is again something which is quite powerful, and it helps deliver services at very, very low cost. And this has manifold benefits across the entire ecosystem, because financialization being available at lower cost is a very, very big enabler for a lot of businesses as well as individuals. Theme 4. So this is the aspect that I really talked about on some of these level of transactions which are there. Beneficiaries here could be banks, asset managers, insurance companies, exchanges, wealth managers, non-banking financial companies, telecom providers, tech providers. So a whole host of companies here which benefit out of this. The final theme for the year that we kind of think is kind of again possibly 1, 2, 3 year sort of phenomenon is particularly post-COVID, we've started to see people value experiences a lot more than goods. So experiential consumption has become a lot more pronounced, and as the per capita incomes also kind of increase, there is this propensity to consume a lot more services and consume a lot more experiences. I think that aspect is kind of playing through, and when you kind of look around in your own personal life, you'll see that there is a lot more travel, tourism, eating out. So a whole host of things which are there. So which is where a lot of industries kind of benefit, whether it is the SaaS players, or whether it is the aviation companies, whether it's the hospitality companies, whether it is real estate developers who kind of operate in this space. So a whole host of players that benefit out of this theme as well. So this is broadly what the macro, how we are looking at it, and what we ideally meant by staying the course is concerned. So typically when we tell investors for equity is concerned, we typically ask them, do your asset allocation. Equity is not the only asset class. Once your asset allocation is done in conjunction with your discussions with your advisor, identify what is your equity portion of the asset mix, and then allocate accordingly to asset managers who have mandates, who run mandates which are in sync with your goals, horizons, who are running portfolios that fit your goals, horizons, etc. So this is something which is quite important, and typically for a large capish sort of a product, we would ideally request investors to take at least a 3+ year view. If it's a flexi cap product, then kind of move to possibly a 4+ year view, and if it's a small mid cap sort of a product, then probably look at a 5+ year sort of a view. That's how we would typically the horizon, depending on the how the risk profile of each of the products is. The horizon needs to be a little longer to accommodate for the volatility that tends to creep in. So which is why we focus on that. Request the investors to focus on that aspect quite a bit. So these are 4 products. So Contra, the style of investing here is leading companies. In pipe, we are really talking about cap, particular bucket. Growth leader strategy is more of flexi cap product. So this invests more growth at a reasonable price sort of investment style, but across large, mid and small caps. Similarly, in Contra as well, it's large, mid and small caps, but then the investment style is slightly different. And value strategy is again something which is the style of investing is value, but it could be large, mid or small caps. Cutting across, because we focus a lot more on earnings growth and ROE improvement and getting them at reasonable risk reward. Whatever fits that particular mandate is what we kind of bring into the product. The outcome of that is today, if you kind of look at the portfolios, in the Contra strategy, we have, actually what's common across all the themes is we have higher indexation towards manufacturing, allied and financial services businesses. We have very little representation towards IT and healthcare or services. Experiential consumption, we predominantly are playing it through the real estate names and the predominantly the more capex intensive businesses, be it telecom, be it aviation, hotels, those kind of names. So that's broadly what is there as far as the consumer names are concerned at this point in time. So this is the most important slide for us. This is the portfolio statistics. This is an output. This is not an input. We do the portfolio construction very bottom up, but today as the portfolio kind of stands, this is the profit growth of the portfolio over 1 year, 3 year, and how the ROEs have kind of improved from FY21 to 23. And these are the trailing price to book and trailing price to earnings ratios. They stack up quite favorably on each of these parameters versus vis-a-vis the benchmark, which is S&P BSE 500. So to that extent, even today, when you kind of look at a bottom-up portfolio, we are able to build a decent enough portfolio, which is which offers good earnings growth, ROE improvement profile, and a decent risk reward. We go for all these 3 combinations. We don't choose 1 or 2. We choose all these 3. So which is where our focus is, and this is what we would like investors to kind of understand and see if this fits their investment horizon, risk appetite, risk reward, then kind of consider these products. That's broadly what is there. So this is our orientation. Typically we focus on earnings growth and delta PE, because any stock to do well, it needs earnings growth and it needs PE movement, whether it's re-rating or de-rating. So if you have both earnings growth and re-rating, then those stock tends to do well. And when you kind of look at bottom up, typically when you look at Nifty 500 return on a yearly basis, you see that, let's say 2010 to 15 was a tough phase, but even within that phase, when you kind of take a 5-year bucket and look at absolute returns during that period, there have been anywhere between 77 to 256 companies, even during those tough years. When you kind of look at a bucket of 5 years, that so many companies out of Nifty 500 that have delivered a 15%, greater than 15% 5-year CAGR, which effectively means anywhere between 15 to 50% of companies can deliver you that return. But to get that kind of an experience, you need to have a really good bottom-up research and not be confined that I will not invest here, I will not invest there. Those kind of prejudices or biases shouldn't be there. You need to evaluate these things more on a bottom-up basis. And this data also, again, same cut, when you kind of bucket those companies into what have they delivered, you clearly see that the companies that have done well have had good profit growth, have had, they maintain high ROEs. And when they were first picked, they had decent risk reward. As you drift down, if the ROE is not heading in the right direction, but still if the profits have been okay, then the multiples have kind of sustained on PE basis but have derated on price to book. Similarly, if you don't have both, which is earnings growth and ROE improvement, then you have a lot more valuation derating. So that's what we tend to avoid, the bottom two buckets, and we tend to focus a lot more on the top bucket, with some companies possibly ending up in the second bucket. So this is where we focus on. This is a 5-step process. We have a very strong research team with which covers about 570 stocks, which is the widest coverage in the Indian markets today at ICICI Prudential. And from that research team's inputs, the alternatives team, which I'm part of, we further use a philosophy called BMV, which is Business Management and Valuation. We use that and bring down the number of companies. Today that number is oscillating around 140 odd companies, which filter through the BMV process, and from there we build depending on the strategy. If it's a pipe strategy, then small and mid caps are what qualify for that bucket. So ideally you would find around 50 odd companies which kind of qualify from there. If it's a contra strategy, then again out of flavor but leading companies could be another around 40 to 50 companies that qualify for that. So depending on the strategy, we bring one level down, and from there we eventually build a 25 to 30 stock portfolio. That's how we go about our process. This is the BMV, which stands for Business Management and Valuation. And this is the research team that I talked about, 70 stocks. The investment team on the alternative side is headed by Mr. Anand Shah with over 23 years of experience. I have close to about 19 years now. My colleague Gitika with close to about 16 years. Sandeep again 15 years. And on the dealing side, Dhaval and Preeti with close to 20 years of experience each. And Vineet about 7 years. So it's a fairly seasoned team which looks at this particular mandates, which is there. So thank you. I'll stop here and possibly take questions. Kamal, hope that's fine.
Perfect, Choka. This was a very insightful presentation. In fact, while you were sharing these slides, many of my existing clients and our audience have been asking for this presentation to be shared eventually, because data that you presented was quite meaningful. We understand, yes, in long term it is the companies that create wealth, not the markets. Markets may have gone up, but the underlying earnings have actually been going up, and future could be, I would say, unimaginable for India, because growth is happening in across the sectors, and that is what you also covered in your presentation. However, whenever there is too much euphoria in the market, and especially in the mid and small cap space, we know SEBI, as one of the regulatory bodies, has acted in the past also, and they have acted now. Like in 2018, I know they came up with regulations which led to fall in mid and small cap stocks, because there was a kind of a new definition given to multi-cap funds, and that had led to some kind of panic in the mid and small cap space. Even now, I could read all the questions in the chat box. They are all hovering around the similar kind of fear, whereby SEBI has kind of given an alarming sign that AUMs in the mid and small cap space of mutual funds have been rising. And that is what is kind of making investors fearful. At the same time, the events like, today market going up would definitely be making investors more optimistic. But what are your views in this regards? Because ICICI AMC is a large AMC, and you represent the same. So this is the foremost question that I want you to address.
Yeah, sure. I think a regulator understands the construct of the market, and I think it's a very, very important and welcome step that they need to ensure that the small investors who are there need to be better guided. So I think in their wisdom, they are seeing certain pockets. So when you kind of look at the valuations, possibly in our presentation also, when you kind of looked at the index level, you did see that valuations were at a premium to the longer term averages, right? So I think in their position and fiduciary responsibility, I think they are doing the right thing by sounding a note of caution to investors, and it's a welcome step. So from time to time, you do need some of these nudges to be there, and for people to take cognizance that if they have they need to reassess their portfolios, whether it's in light of whether the portfolios are in sync with the mandates that they've been wanting to pursue as far as their investing goals and horizons are concerned. So I think it's a important step. People will have to have the conversation with their advisors, and look at it. What we at our end so which is where if you kind of look at our portfolio, what we've kind of done also is concerned. We've built a very, very bottom-up portfolio, and we are telling investors very clearly when you're coming into this asset class, this is a high-risk asset class. So which is where time and again I'm harping on the point that if you're into a segment like a mid and small cap, always have a 5+ year view sort of a time frame. Don't come with a shorter time frame in mind, and that's where one needs to be a lot more balanced with regards to that approach. And it's important to understand that equity is not the only asset class. It's one among all the other asset classes. So do your asset allocation, and after that allocate to equity, whatever portion is there, depending on the individual investor's risk appetite and time horizon. So I think first do the asset allocation, and second, depending on the horizon and risk appetite, decide on what sort of funds actually suit your investment needs. I think on that front, bottom up today, even today, we are able to build decent portfolios, which is where I highlighted that slide from our for our strategy. For example, the 4 strategies, you would have seen the earnings growth, ROE improvement, and the valuations, both in terms of price to book and price to earnings is concerned. So I think it's important to look at that particular aspect for pretty much every portfolio. There'll be certain key parameters, and look at that and understand that, and then reevaluate it.
Sure, Choka. So now the first part of the, I would say, webinar is more or less over, whereby you have covered your house view. You have been research analyst, and I'm sure you are managing your own portfolio as well. I want to now maybe spend some time with you to understand your own view as a research analyst and as a fund manager at these levels of markets. Are you comfortable with the valuations, or you think valuations are actually looking not comfortable and fair?
No, so like I highlighted, bottom up, you're still able to build a decent portfolio. So we most of the portfolios that we showcased have anywhere between 25 to 30 stock portfolio, or built over a 1 year time frame, right? So when we initially built a portfolio, it's been about 35 to 40 stock portfolio, but eventually when we shrink it over a period of 1 year, it becomes a lot more tighter, and we build a 25 to 30 stock portfolio, and we're still able to build bottom up a decent portfolio. So that's still not a challenge, but you'll have to do a lot more hard work when the starting valuations at the market levels are punchy. So it's not as easily available. Say 2 years back, you found a lot more names. Today, the number of names that are kind of filtering through are fewer versus what it was, say, 2 years back. So that change is definitely there. But even today, you're able to build a decent portfolio. But one important underlying assumption is, depending on the strategy, we are taking either a 3, 4, or 5 year view. So if it's a large cap sort of a product, we take a 3+ year view. If it's a flexi cap sort of a product, we take a 4+ year view. And if it's a small cap sort of a product, we take a 5 year+ view. So that's how we take it.
Sure, Choka. So, one of your popular PMSs is ICICI Contra PMS, which follows a contrarian approach, and market over time throws, contrarian, I would say, opportunities. Like, for example, today, tech is one sector which has not participated in last 2 years of rally, or specialty chemicals is a sector which has not participated in last 2 years of rally, or I would say private banks have also not participated in the rally. So do you see that, yes, again, your contrarian approach will now want to change the portfolio towards some of these sectors with some of these stocks and some of the sectors from these stocks which have actually not participated, or you still feel it is like too early to say so?
Okay, so good part is the country is growing at about 10-12% sort of nominal GDP growth. So when that happens, you have companies which are pretty much available in every particular sector is concerned. So that's not a challenge. Now, the only thing is you need to, because of the structure of the mandates which are there in our PMS, we typically go for more concentrated portfolios, which is what the client and investors basically are looking for. Now, when you're taking that approach, you're ideally building a 25 to 30 stock portfolio at our level. You will not always find investment ideas from every sector. At that given point in time, we try and see what are the best ideas, 25, 30 stock ideas which are there. Fortunately or unfortunately, it might be tilted towards a few sectors. Say, for example, in 2020, the orientation towards financials was actually relatively lower, but orientation towards tech and pharma was relatively higher, along with metals and cap goods. In 21, that for us changed in this I'm talking about the contra portfolio itself. In 21, the orientation towards pharma actually reduced quite a bit, and tech also started reducing, but financials started increasing a little bit. In 22, actually we went completely zero on tech and pharma, and then put a lot of weight into financials. Went more overweight on cap goods and other manufacturing allied businesses, and also some of these experiential consumption sort of names. And 23, we went a little more on the material names. We reduced a little bit of our financial names wherever we had good risk reward, already performance kind of come through. We trimmed some of those and we moved it into other areas. So as we head into 24, these are the 5 broad themes that I kind of covered where we feel there is decent risk reward. And these are, some of them are slightly ahead, some of them are in the middle of it. So that's how it is. Regarding chemicals, we've had a little more bulk chemical companies than spec chem companies, because spec chem companies, the issues that we've had bottom up. This is not again a broad brush on the sector, but more bottom up. The challenge that we've had is the companies have had good growth, but then the problem is their capex intensity is very, very high. But despite the capex intensity being very high, their valuation multiples have been higher than even FMCG companies, where FMCG companies kind of deliver that kind of a cash flow without too much capex. While they may not have as much growth, without capex they deliver a lot of cash flows. So some of these spec chem companies being available at such punchy valuations, it didn't make too much great risk reward. That's why we've not still seen any of those names kind of feature up, but we did have a few bulk chemical companies. Similarly, when you kind of look at financials, we do have bottom up a fair amount of companies. So there I don't see this thing. So whenever that opportunity comes, we have added. IT, while companies are great, our one challenge is, say if you kind of compare between 2020 and today, pre-COVID, we were at about 7-8% sort of dollar revenue growth. Today also you're getting the same dollar revenue growth. When you look at FY25, FY24 was actually even lesser. Margins were much better. Today margins are lower. They're possibly improving, but they'll possibly settle back to the pre-COVID levels. But when you look at the valuations for that particular sector, the valuations are actually at about 30 to 50% more expensive for a lot of companies. So which is the challenge that we have with IT. It's not that you don't find good companies. In fact, they're great companies. But our challenge has been the risk reward. So for any company that we pick, we need 3 things. We need, for it to first filter through the BMV. Then after that, it needs to have good earnings growth, good ROE improvement, and it needs to offer good risk reward. So it needs all three. It should not so happen that it offers only two. If it doesn't offer the triangle is not there, then we have an issue, and it typically doesn't come into the portfolio. But that said, let's say, for example, we have found one or two names in the IT space, in the mid and small cap product, which is Pipe. We do have one or two names, which we've not been able to find in the in the flexi cap products. Some of the large cap names haven't made as much sense. So depending on the mandate, we've kind of picked some of these names. Whatever are the 25 to 30 best ideas that fit a particular mandate, that's what we've kind of picked and built the portfolio around.
Sure, Choka. So, there's another PMS that you have, which is also a PMS which is focused towards large cap, and a popular one, ICICI Value. How do you differentiate ICICI Value from Contra?
Okay. So there the style is a little more, value oriented. So see, in Contra, what you have is but leading companies. In value, you could have a leading company or you may not have a leading company, but you're ideally looking for companies which are good companies. But if you're seeing some semblance of earnings growth, then you kind of take them. Versus the past, if the earnings growth is better, then you have chances that it can actually do well, and the ROE improvement is there. Then you start to build that portfolio around that. So it's a lot more. There's a tiny bit of difference between the Contra and value style of investing. So that's where the big differentiation between the two is. Both are flexi cap products. Value is one, but then it kind of more than made up in 22-23. So again, if you kind of take a more 4-year sort of a bucket for these kind of flexi cap products, I think that's the right orientation to kind of look at some of these flexi cap products and look at it. Both the strategies have done pretty well.
Right. Going ahead from here in the next financial year, what is your personal view? What are the I would say risks one should be wary of? Because at the peak of euphoria, one generally tends to forget the things which could go adverse. But you are a fund manager, and if you kind of talk like an investor, not like purely a fund manager coming from ICICI Prudential, what is your, I would say, thought in this regards?
No, I think what one needs to understand is, there are 2 or 3 things. One, obviously, this is a year of elections across the globe. There are more than 70 countries which are heading into elections. The 2 most important ones, as far as our markets are concerned, is Indian elections and US elections. I think, that's something. There'll be volatility around those 2, large events. That's something to be mindful of. Second, in terms of activity levels, I think there is a lot more derivatives positioning and market activity, which is a lot more volatile. So you need to focus a lot more towards. You cannot wish away volatility, but you can guard against risk. You need to pick a portfolio with a more longer term orientation and ensure that you don't expose any part of the portfolio to permanent risk of capital. That's the most important thing. If you do that, then in the long run, actually, one should be reasonably okay. One needs to stick to a investment philosophy that's kind of time tested. One needs to follow that with a discipline, and I think it needs to be a lot more process oriented. So that's where I would say one needs to be very, very focused about. I think that's the major thing. So risk typically come from areas that you don't anticipate from. So which is where you need to be focused on companies which are inherently very strong, and they are poised for improving their ROE profile over a certain time frame. Because if they're doing the right things, then relative to the industry in which they operate, they tend to be on the right side of where the industry is evolving. And finally, you need to be cognizant of risk reward. If you're not cognizant of risk reward, then you need all three. You can't have a decent investment experience. So that's the most important thing that we focus on. We focus on what's controllable rather than being paranoid about what's not under our control. So I think as we improve our horizon, I think we improve our chances of creating decent investment.
Sure, Joka. I think we have covered almost every aspect that we wanted to cover in this presentation, and the entire, I would say, Euphoria has a very logical, fundamental reason to be euphoric about. We at PMSAF World have been actually quite optimistic about India's growth story since 2020. Even during COVID period, we have been giving I would say cautiously optimistic stance, and a lot of our clients since then have been allocating money to equities and have actually built a lot of wealth. And today at this juncture, I would say that we have reached a level where almost all clients of ours are so much, I would say, delighted based on their well-informed investment decisions that they have taken. And at the same time, we are also very much cautious of rising valuations. But given the fact that we are in this long-term journey, we keep doing such webinars to keep reiterating to our clients that stay the course. And that is where I would like to conclude this very insightful webinar. Thank you so much for joining with us today. Thank you, Joka, for your time.
Thank you. Thanks everyone for joining in. It was thanks a lot for the opportunity, Kamal. Very, very, very helpful, and happy weekend to everyone. Thank you, and happy investing.